Welcome back to the show. Today, we're tackling something every investor eventually faces, but very few prepare for: the emotional battlefield of a bear market. Joining me is a behavioral finance specialist who studies why our minds often become our biggest financial liability. Let me ask you this: bear markets don't just shrink portfolios, they seem to shrink confidence too. Why do even smart investors make their biggest mistakes when markets fall?
That's because bear markets aren't really tests of intelligence. They're tests of emotional endurance. When your portfolio drops 10%, 20%, even 40%, your brain doesn't interpret it as numbers on a screen. It interprets it as danger. Thousands of years of evolution wired us to escape threats immediately. The problem is, the stock market isn't a lion hiding in the bushes, yet your brain reacts as though it is. Imagine checking your investment account every morning and watching another wave of red. At first, you tell yourself, "I'll stay calm." Then the headlines arrive. Friends start saying they're selling. Social media fills with predictions of financial collapse. Suddenly, you're not just fighting the market, you're fighting your own mind. This is where loss aversion quietly takes over. Behavioral finance teaches us that the pain of losing money feels roughly twice as powerful as the joy of gaining it. That's why investors often abandon carefully built long-term plans during a stock market crash. Ironically, they don't sell because they've analyzed new information. They sell because fear becomes louder than logic. History has repeated this lesson countless times. During the 2008 financial crisis, many investors exited near the bottom, convinced recovery was years away. Yet those who remained disciplined experienced one of the strongest bull markets in history. The same pattern appeared during the COVID-19 crash in 2020. Panic peaked just before one of the fastest recoveries the market had ever seen. Warren Buffett famously reminds investors to be fearful when others are greedy and greedy when others are fearful. That sounds simple until you're living through a bear market. Charlie Munger often emphasized that investing isn't supposed to be easy. If you're uncomfortable at times, you're probably experiencing what every successful long-term investor has had to endure. Here's what's fascinating. Bear markets don't just reveal your portfolio, they reveal your preparation. If your conviction depends on rising prices, it isn't conviction at all. Real confidence is built before the storm arrives, not while you're standing in the rain. Howard Marks often speaks about market cycles, reminding us that extremes never last forever. Every bull market eventually cools, and every bear market eventually ends. That's not optimism, it's history. The investors who consistently build wealth understand that market timing isn't about predicting the exact bottom. It's about managing your emotions so they don't dictate your decisions. So the question isn't whether another bear market will come. It will. The real question is whether you'll see it as a disaster or as an opportunity that only emotionally disciplined investors are prepared to recognize. Sometimes the greatest investment you can make isn't buying another stock. It's strengthening.
That's a perspective worth remembering. Bear markets may test your portfolio, but they shape your character as an investor. If today's conversation challenged the way you think about market timing and investing psychology, subscribe, share this episode with someone who needs it, and we'll see you in the next discussion.